Well, good afternoon. Happy Friday, August 1st, first day of August. Mark Milam here, your mortgage professional. Let's get right to it. Really, a week that we largely anticipated until today. We knew the Fed wasn't going to cut the Fed funds rate on Wednesday. We knew there would probably be some dissension within the ranks of the voting members, and certainly there was for the first time in a long time since the 1990s. We had two members of the Fed dissent and actually vote for a change to the Fed funds rate. The other nine members voted to keep the Fed funds rate stagnant, and there was one member who actually abstained and did not vote. So the total of the 12 voting members, it was 9-2, keeping the Fed funds rate where it is. But that in and of itself is somewhat historic to have two members, Michelle Bowman and Christopher Waller, who dissented and actually voted for a quarter-point rate cut. As we move into Thursday, jobless claims came in fairly weak, and then we got today's non-farm payroll report. And boy, this is important to pay attention to. Maybe the most consequential economic report as it pertains to mortgage rates and home ownership affordability. It's one of those we really want to keep our eye on. And here is what happened in the market today. We have seen mortgage-backed securities take off, headed north. That's exactly the direction we want them to go, because that means interest rates are headed lower when we see mortgage-backed securities headed higher. Well, why did this happen? So let's go over here and take a quick look at the Bureau of Labor Statistics Employment Situation Summary. This is the report that was issued this morning, Friday, August 1st, that said that we added about 73,000 jobs in July. Now listen, 73,000 is a fairly weak number, but our estimate was only about 108,000. So yeah, we came in under estimates. That's what we want to see. We want to see that labor is not going to reignite inflation, but that's not what is causing mortgage interest rates to fall today rather precipitously. What is causing that is the very last paragraph of this release, and I'm going to scroll all the way down the page so you can see it. Let's take it all the way to the bottom, and it's right here, and it's all about the revisions for May and June. So it goes to say that the revisions for May and June were larger than normal. That is an understatement, my friends. The change in total non-farm payroll employment for May was revised down by 125,000 jobs. We said we added 144,000 jobs in May, when in fact we only added 19,000. That is a massive revision. Not to be outdone, the change for June was revised down by 133,000 jobs from a reported 147, not exactly a super strong number, but a healthy number, revised all the way down to 14,000 jobs. With these revisions, employment numbers from May and June are now over 250,000 lower than previously reported. Folks, that is huge news. That tells us that the labor market that we have been looking at and saying, wow, look at how resilient labor is, isn't quite as resilient as we thought. And in fact, we are dangerously close to a contraction in the labor market when we're only adding 14,000 or so jobs in 1 month, and then another month 19,000 or so jobs. So when these revisions are making their way in, they are wildly changing these numbers, and that's what's causing your sell-off actually that's what's causing the mortgage-backed securities to go up and interest rates to come down. Let's continue on this trend and see what else we've got for you. This is Fed Watch probabilities, or futures traders, for a September rate cut. Let me blow this up a little bit if I can. You can see it more clearly. Yesterday, we were looking at a roughly 37% chance of a Fed rate cut on the September meeting. As of that revision to the non-farm payrolls number, this probability has increased now to 82.8%. That is a huge increase in 1 day in terms of what we think is going to happen now with the Fed funds rate come the September 17th meeting. Do want to show you this as well. So one of the things that's keeping unemployment low is the labor force participation rate. And here's what the labor force participation rate does. It takes everybody who is of working age, it's 16 or older, that is here in the United States, and it says what percentage of these people are actually working. And that number has continued to decline as we've moved throughout the year. In fact, we're way down. We're now down, I think, 62.2, something like that, for the labor force participation rate. And every time that falls, it drags down with it the unemployment rate, because if the people are not looking for work, then they're not counted as unemployed. So it's important to note, as we talk about the labor force participation rate, that if we had just kept a labor force participation rate like we had in May, unemployment would actually not be at 4.2%, it would be at 4.9%, almost at 5%. That is a huge move, and thanks to our friends at Arch Mortgage Insurance for providing this color. It is really fascinating to see what is happening in the labor market. Of course, we have the labor force participation rate that we have, but ultimately what it means, and I'll show you this, this is the labor force participation rate here, and you can see it dropping rather precipitously down right here around 62.2%. When we had seen it closer to 63% earlier in the year. All right, and we'll move on to existing home sales. Existing home sales now nationally showing a 4.6 months worth of supply. Why is that noteworthy? Well, because that's the highest level we've seen, with the exception of 1 month at the start of the pandemic. That's the highest level that we have seen since July of 2016. Going back a full decade, we haven't seen a market this balanced in favor of neither the seller nor the buyer having the upper hand in terms of negotiation. It's the most balanced market we've really seen over the past 10 years. If you're a buyer that's sitting on the sidelines thinking, is now the right time to buy, or is now a time I should wait, you may not have as much leverage anytime in the near future as you have right now, because we just haven't seen this much supply in the marketplace over the past 10 years. And with rates falling, it's liable that many people are going to step off the sidelines and get back in the hunt for a home. So definitely an encouraging sign. If you want to get out and you're looking to buy right now, you may have more leverage and negotiating power than you've been privileged with over the past 10 years. Finally, we'll close out. Fannie Mae reported their quarterly earnings. Fannie Mae reported Q2 earnings at $3.3 billion of net income. That's right, net income, not gross. That's the 30th consecutive quarter of positive net income for Fannie Mae, and their net worth now eclipsing $100 billion, up to $101.6 billion, an increase of $88 billion since the start of 2020. Okay, that's all I've got for you today. If I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam at highlandmtg.com.